How do interest rates influence international capital flows? Imagine a world where money moves like a river, flowing from one country to another based on where it can grow the most. That's what happens with international capital flows. When a country changes its interest rates, it can cause a ripple effect across the global financial scene. Interest rates are like the price of borrowing money. When a country raises its interest rates, it makes saving and investing in that country more attractive. Investors see higher returns on bonds, deposits, or other financial assets. So, they move their money into that country to earn those better yields. This is called capital inflow. On the flip side, if a country lowers its interest rates, its assets become less appealing. Investors might look elsewhere for higher returns, leading to capital outflows. Money leaves the country, seeking better opportunities abroad. This movement of money is driven by the desire to maximize returns on investments. The way interest rates influence these flows is explained by economic models like the Mundell-Fleming model. It predicts that when a country's interest rates go up, more foreign capital comes in. When rates go down, capital tends to leave. Countries with open markets and no strict controls see these movements happen more freely. Expectations about exchange rates also play a role. According to the interest rate parity theory, if a country has higher interest rates, its currency might initially appreciate because of the inflow of foreign money. But if investors expect the currency to weaken later, they might hold back. These expectations can cause volatility in exchange rates and influence how much capital moves in or out. Central banks influence interest rates through monetary policy. When they want to stimulate the economy, they lower interest rates. This makes borrowing cheaper but can lead to less foreign investment. Conversely, raising interest rates can attract foreign investors, strengthen the currency, and slow down economic growth. Large inflows of capital driven by interest rate differences can also affect long-term interest rates. For example, when foreign investors buy a lot of bonds in a country, it can push down long-term yields. This impacts borrowing costs for governments and businesses. In short, interest rates are a key factor in international capital flows because they change the attractiveness of a country's assets. These flows influence exchange rates, financial stability, and even how countries craft their economic policies. When interest rates go up or down, they set off a chain reaction that moves money across borders, shaping the global financial environment.